Back to our main story of the day, and that is President Bush's much-awaited economic stimulus package. The plan came out overnight, containing largely what we had been led to believe throughout the past week. Let's get another perspective on the plan itself and how it might impact the economy. Peter Churchouse is Managing Director at Morgan Stanley. He's live in our Hong Kong studio today. Peter, thanks very much for being with us once again. Welcome to the show.
Glad to be here.
In sum, your analysis of the impact of this package.
Well, I think, of course, it's going to have a positive impact on the U.S. economy. It's just a continuation of earlier fiscal and monetary stimulus packages that we've seen out of the U.S., which have gathered steam over the course of the past 12 months. So I'm quite confident that this is going to have a positive spin for the economy. It's not going to suddenly lead to a doubling of consumer spending or anything like that, but at the margin it must be seen as positive, and it's just a continuation of previous policies. Good news indeed.
Peter, why do you think it's necessary to spend $674 billion of government money when the economy grew at a little bit more than 3% last year, which is not bad growth, when the government keeps insisting that the economy's in a good situation, when we've had interest rate cuts that we've had in the United States, and continuing assurances from the Federal Reserve that we're doing well?
Well, I think, of course, that people do see the risks in the U.S., that this is a world that is a U.S.-centric global growth world right now, and the risks still are perhaps to an edge into deflation, and I think the Bush administration is right to see these risks and to ensure with these packages that perhaps the world will not slide into some sort of deflationary spiral. So I think this is basically a very good step for the global economy generally, and is really a continuation, I think, of what have been extremely sound policies over the course of the last year or so.
Is it possible that this, the mainstay portion of the stimulus package, the treatment of dividends, could wreak some havoc with other financial markets? I mean, for instance, this morning people are sort of mulling over what does this mean for real estate investment trusts, which have been attractive to investors because of their dividend yields. This might change the whole landscape. Bonds, bond interest, which is paid to bondholders, continues to be taxed. Looks like it'll continue to be taxed under this plan. This could really wreak havoc and kind of change the entire environment.
Well, absolutely, and I think as far as comments on the bond market is concerned, this financial deficit in the U.S. is going to have to be financed by something. So I think this is negative for bonds in the U.S. Certainly. I think as far as your comments on investment trusts, property investment trusts are concerned, absolutely correct. These trusts have outperformed the U.S. index pretty dramatically last year, but they did slow down in the fourth quarter. So I think we are expecting to see a rotation out of these dividend kind of stocks anyway, and perhaps a little bit more of a focus back on growth stocks as the economy recovers. So yes, there will be structural changes here, and I think we've already highlighted some of these as far as, for example, the U.S. real estate trusts are concerned anyway.
Peter, why on earth, under these circumstances, when they're cutting dividend taxes, and there's talk, obviously, of the impact of this being corporations beginning to give out more dividends on the back of that, why would people start focusing on growth stocks?
Well, basically, if you are looking at a period where we are going to see a continuation of a reasonably robust consumer, and I think you are looking at an acceleration of economic growth this year, and perhaps a major acceleration next year. We're looking to see a 4% growth in the US in 2004. I think through the course of this year, you are going to see that shift and focus away from yield-based instruments that have been so popular in the last 12 months back into growth. And the usual story, growth at a reasonable price, of course. Problem in the US is that the markets are not as cheap as we've seen in the past. So this question of finding growth at a reasonable price, I think, is still going to dominate the investment in the growth arena.
There's a whole slew of Asian companies that trade on Wall Street, either have with direct listings or through the depository receipt market. This plan on dividends, is this, have you guys crunched through any of the effect on Asian companies as a result of changes to the dividend payout policies?
Well, generally speaking, Asian companies have not been great dividend payers, perhaps with the exception of Hong Kong, where the dividend yield in Hong Kong is about 4%, about twice what it is in the US right now. But certainly some of the big Chinese companies are talking about starting to pay out a bigger dividend. We see it in the mobile sector, we see it in the energy sector, and I wouldn't be surprised to see this gathering steam around the region, particularly in some of the areas where we've not seen a lot of dividend payout. That would be certainly in the technology area. Many of these companies do have decent cash reserves, and I think could afford to pay out a little bit of dividends or perhaps share buybacks. That's the other way to enhance performance for shareholders.
Peter, we'll pick up this topic with a bit more detail about the bond market and also some of the implications for consumer spending. So stay with us. Peter Churchouse is with Morgan Stanley in our Hong Kong studios. We'll carry on with this conversation after this break. Stay with us. Welcome back to Asia Market Watch at 11:10 a.m. Hong Kong, Singapore time. We're talking to Peter Churchouse of Morgan Stanley about the U.S. economic stimulus package. Peter, the Morgan Stanley global chief economist, Stephen Roach, says in his latest commentary that this is simply an attempt, it's the last attempt by the U.S. government to try and maintain the state of the U.S. economy because the interest rate cuts haven't worked. And basically all they've got now is an attempt to stimulate the stock market to try and keep consumer confidence high. Do you think this is a last gasp attempt?
I can't say that these previous stimulus packages in form of interest rates and fiscal stimulus has not worked. We've seen the housing market remain very strong. We've seen the consumer remain remarkably resilient through this economic downturn. So I'm not convinced that it hasn't worked. I think it probably has worked. If we hadn't had these packages, I think you could have seen a much worse scenario in the U.S. economy. And now the next step perhaps is to, what I find ironical is that many of the pundits of a couple of years ago were saying how the booming stock market was underpinning the consumer by the wealth effect. And now the same pundits are sitting back saying, well, you know, anything that tries to push the stock market up isn't going to have an effect on the consumer sentiment. You can't have it both ways, fellas, and it's got to be one way or the other. And I think this definitely will have the impact of really just helping to keep the consumer resilient until such time as we see investment spending picking up again, perhaps in the latter part of this year.
Peter, of course, you and I never listen to pundits being sensible people, because in the past 2 years they've all been telling us the stocks are going to go up, and they have been miserably wrong. Nonetheless, you mentioned the consumer here, and you're saying that they have been resilient, which is an interesting point, because how much more spending can they do? I mean, we have seen consumer spending holding up to almost the highest levels that we've seen in a long time. So putting more money back into their pockets doesn't necessarily mean they're going to spend any more, does it?
Well, that's right. I think we are seeing certainly the consumer in the U.S. is paying down a little bit of debt. We're seeing the savings ratio is picking up a little bit in the U.S. But it's still surprising to most of us how the consumer can still find things to spend the money on. We've seen the auto sector, despite lots of cost cutting and so on, has still been remarkably robust. We've seen quite decent sales in certain areas of the technology area. So I suspect that the consumer could always find things to spend on. And of course the services sector is one of the key areas of the U.S. economy right now, and we all keep consuming more and more services in these times anyway.
Are they continuing to spend in the right places to benefit companies here?
As far as here is concerned, yes, I think there is certainly in some cases that is correct. This part of the world always benefits from a pickup in the U.S. economy. But what I think is of concern is that this world is becoming too U.S.-centric. And I think there has been a need, I think, to see domestic economies in this part of the world pick up their domestic consumption. We've certainly seen that in Korea. We have not seen it to the same extent elsewhere. That's something I would like to see in this part of the world.
Certainly, Peter, the argument about the weightings of the world in a global economy, we would like to see more diversification in terms of demand, for sure, but that's a subject for a different day. Let's just finish off by asking you, you're very bullish on the United States and the situation there. In that context, therefore, would you advise investors to be invested in U.S. stocks, or do you think that the Asian stock markets are going to outperform again this year?
I think, quite frankly, I think we're going to see the Asian stock markets outperform the U.S. again this year, for the simple reason they have more operating leverage to a pickup in the U.S. economy than just about anywhere else. We're looking to see about 17% earnings growth across the region here in Asia right now. The Asian stock markets are not expensive by historical standards compared with the U.S., where prices are still relatively high in traditional valuation metrics. So we feel that we'd rather be overweight as far as equities are concerned in the Asian markets rather than North America.
Peter, appreciate your comments this morning. Peter Churchouse is with Morgan Stanley in our Hong Kong studios today.